Hello instructors, ladies and gentlemen, students. My name is Anthony Woods and I'm here to present to you some software I developed for accounting and finance, formula calculations. These are tools for analysts for business majors, business people in the corporate world, small business owners, instructors and students alike. These are some tools you can use in your classes to have and to understand the financial statements that go along with the accounting and finance. While I demonstrate this, I just want to make you turn your attention to this calculator I've developed to help you calculate the financial formula calculations that you can input on each of the various menus of liquidity, solvency, profitability, LIFO, and FIFO. It's just a little tool you can use on the side, or instead of bringing up your desktop calculator, have a nice little convenient tool I put together here for you to use. I also include a little calendar for the date that you are in this software designated as that particular date. You can kind of look at this as this little convenient little tool. Now I would like to present to you the calculations based on these formulas that are used throughout the accounting and finance field in colleges and schools all over the country and all over the world. First, we will click on the button called the Liquidity, which is a tool that analysts use to calculate various formulas such as working capital, current ratio, asset test or quick ratio, current cash debt coverage ratios, inventory turnover ratios, days in inventory or cash to daily cash expenses ratios, credit risk ratios, receivable turnover ratios, and average collection period. Okay, I would turn your attention to working capital. Once you click on the button of working capital, you will see the calculation. The result of that is the current assets minus current liabilities will give you the working capital of this particular formula calculation that accounting majors, business majors, and finance business people use. We'll start by inputting some values here, such as in current assets. We will input values of let's just say 2,063,091,100,000, and we'll subtract that by 3,086,907,000. Okay, and all you have to do after that is click on your calculate button to get the value of your working capital. Okay, and that is your value is $678,184,000. Okay, and you can also look at how you can input these values based on thousands, hundreds of thousands, millions, or billions, and to come up with the working capital value based on current assets minus current liabilities. Also, let me turn your attention to the clear data field button. You can click on that just to simply clear out and enter into new values for current assets and current liability to create a new working capital amount field result. I'm not going to go through all of these through liquidity. I just want to give you an example of some how the formulas work. I'll just briefly click on the other one so you can look at the screens and see what they consist of. Current ratio result consists of current assets divided by current liabilities. acid test or quick ratios are cash plus short-term investments plus accounts receivables, which is a net figure, divided by current liabilities, equal the results of acid test ratios. Current cash debt coverage ratios is cash provided by operations divided by average current liabilities. Get your result of current cash debt coverage ratios. Inventory turnover ratio. It's your cost of goods sold divided by the average inventory. Give you the results of inventory turnover ratios. Days in inventory. Give you a day of 365 fixed day of the year, which is not leap years, measured in a regular calendar year, divided by inventory turnover ratio. Give you the results in days in inventory. You can put a figure in such as 7.9, and then it comes up with the days in inventory for that particular product, which is 46.2 days. Cash to daily cash expenses ratios. As you can see, cash and cash equivalents divided by average daily cash expenses divided by 365 days a year gives you the result for cash to daily cash expense ratios. Credit risk ratios. Allowance for doubtful accounts from your financial statements divided by your accounts receivable from your financial statement give you the credit risk ratios. Receivable turnover ratios. Okay. Includes your consists of your net credit sales divided by average net receivables and your average collection period, which is 365 calendar year days divided by the receivable turnover ratio. As an example, give you the average collection period of 37.2 days. Thank you. This ends the liquidity tools for analysts, formula calculations for each one of these formulas. We're going to now go to solvency. Look at the debt to total assets ratios, which consist of total liabilities divided by total assets. Give you the debt to total assets ratios. Cash debt coverage ratio is cash provided operation divided by average total liabilities. It results in cash debt coverage ratio. Free cash flow is cash provided by operations on your financial statements minus your capital expenditures minus your cash dividends from your financial statements give you the result of free cash flow. You have your times interest earned ratio, which is your net income plus your interest expense plus tax expense divided by interest expense. And your last one is your capital expenditure ratio, which is cash provided by operations divided by capital expenditures. Gives you the result of your capital expenditure ratio. Thank you. Profitability. Okay, we have return on assets ratios. These formula calculations consist of net income divided by average total assets. Profit margin ratios, which is net income divided by net sales. Give you your profit margin ratio. Gross profit rate is gross profit divided by net sales. Give you your gross profit rate. Operating expenses to sales ratio is your operating expenses divided by net sales equal operating expenses to sales ratio. Average useful life of plant assets. Okay. Which is your average cost of plant assets from your financial statement divided by your depreciation expenses from your financial statement as well. Give you your average useful life of plant assets. Asset turnover ratios. Asset turnover ratios are net sales divided by average total assets. Payout ratios. Payout ratios, cash dividends declared on common stock from your financial statement divided by net income equal to your payout ratio. Dividend yield is cash declared per share divided by stock price at year end. It gives you the result of the dividend yield. Earnings per share is net income minus preferred stock dividends divided by average common stocks outstanding. Average common shares outstanding. Give you your earnings per share. Price earnings ratio is your stock price per share divided by earnings per share. Give you your price earnings ratios. Return on common stockholders' equity consists of net income minus preferred stock dividends divided by average common stockholders' equity equal return on common stockholders' equity. That's the result that will go on your financial statements. And your cash return on sales ratios. Cash provided by operations divided by net sales will give you that result of cash return on sales ratio. That concludes the profitability portion of this formula calculations. We have LIFO now, which is different from the calculation of the current ratio of liquidity. You have current assets divided by current liabilities under LIFO. LIFO meaning last in, first out. An inventory costing method that assumes that the cost of the latest units purchased at the first to be allocated as cost of goods sold. Now we have inventory turnover ratio. We have cost of goods sold divided by average inventory. Give you the inventory turnover ratio under LIFO. FIFO. First in, first out method is an inventory costing method that assumes that the cost of the earliest goods purchased are the first to be recognized as cost of goods sold. Once again, we have current ratio equal current assets divided by current liabilities. We'll give you a current ratio. Inventory turnover ratio equal cost of goods sold divided by average inventory. Cost of goods sold divided by average inventory. You will input the values in the text boxes here to get your result of inventory turnover ratio. This concludes this video on the software that will be available soon on my website to download for instructors, business people, students, and anyone that's interested in using this as a tool to calculate various calculation formulas. Thank you.